So excited to have you guys here. Thank you for joining us. This is our first time having a joint Zoom, Derrick and I. Well, we're going to get started with today's gift of the shift. So for those of you who have not met me, my name is Lizy Hoeffer. I've been a loan officer since 2008 with the original bust, but I've been working in mortgages since 2002. So I've actually seen a couple of different cycles from, before the boom, the bust, the recovery, and then whatever the hell we're going to call this. So I have been there. I've had the pleasure of getting to know Mr. Derrick Polder almost my entire career.
It's been a long time.
We used to work at a company called Nova Home Loans together, and I've never seen anyone be scrappier, more hardworking, more resilient than Derrick Polder. In fact, his team's closed over $1 billion in sales, and they're like 500 plus producers, like in terms of deals every year. They always make the top 1% list. I mean, Derrick's a super stand-up guy, and he's a data nerd just like me. So if you guys know anything about me, I love numbers, data. I love to study the economy. So I'm super pumped to be able to share this information with you guys, because we're going to give you all the best tips that we have for how we've overcome and found ways to thrive in markets that shift. So Derrick, I'm super excited to have you with me today.
I'm happy to be here. And, I think you're a great example of shifting with the market. As you mentioned, Lizy and I have worked together for a long time. We worked at the same company, and we used to go back and forth on the leaderboard. And then I ran into Lizy a couple years later, and I was like, "Oh, hey, are you still crushing?" She's like, "Oh, actually, I'm doing X amount of deals." And me putting my foot in my mouth, I think I just said something that was very directive, like, "What happened?" And
what happened to you?
What happened? And lo and behold, this monster comes roaring back a year or two later. And, for those of you who don't know, not only does Lizy love data, but she loves closing loans. She consistently does over 1,000 units. So she's an absolute monster. So Lizy and I were geeking out on what we thought the opportunities were in this market. And, we now have the pleasure of working together again. She says, "You know what? Let's share this information with our industry, because I think a lot of people need to hear it. And I love the way that you geek out like I do. So I'm excited to geek out and share that with you guys."
Yay. So let's get started, guys. I kind of want to do a state of the union on like where the heck we are as it relates to the marketplace. Okay. So some things that I know, and I'm going to share my screen. So hold on one sec. Let me see. Okay. All right. So here's a couple things, guys. We know that right now, the news, we know that in social media, we know that everyone who is a quote unquote real estate expert is talking about a potential crash. It is nonstop. I do a lot of YouTube lives. I do a lot of Q&As on my social media, and no joke, the most prominent question is, when do I think real estate is going to crash, or when do I see home values going down? Second question I get asked is, when do I see interest rates coming down? So I will tell you guys that almost 20 years in the business, people ask this question regardless of the season. Okay. Interest rates will be 7% historical low, right? This is a true story. And people are like, "Oh, they're going to get lower." And it did get lower, right? It went lower to like 6.5, the same 5.5, and then 4.5. And we've seen it. But then there are times when things go up, right? And then people always think about the greater times. And the one thing that I will tell you that stands true in any marketplace is that time in the market wins, not timing the market. Timing the market is always lagging, because we have to look back at data. We have to look back at time, right? In order to tell, right, when the bottom actually was, when the best time was. So things that I know to be true, right, is that there are some similarities between what happened or is happening right now versus what happened in the boom / bust, right? So the 2000s, and I want to acknowledge them, right? So there's a large demand in housing. So when I worked in the original boom, there were lotteries, there were multiple bids on houses, people were waiving appraisals, contingencies, they were super aggressive. There was also large investor demand. We saw rapid increases in home prices. We saw, a lot of interesting economic fears. There was a lot of talk about inflation at that time. And what's interesting about that, like, these are the similarities, right? But there's a significant number of differences and specifically as it relates to the economy, right? So one thing that I want you guys to write down, because it's not in this deck, is that original housing boom bust was started due to real estate and bad loans. Okay. We started writing loans where people didn't have to qualify for income. They didn't have to qualify with documentation. They had no money down, right? You could own as many houses as you wanted to apply for in an application, and they were just ridiculous. And so when you have an economy that's based on falsities, and right, and there's arguments for that, but this was legit, like people didn't qualify, we gave them bad loans, and they had no skin in the game, right? It's a recipe for disaster. Recessions, guys, are just 2 consecutive quarters of low GDP. So it is not anything real estate related, just so you guys know.
We're going to talk more about that.
Yep, and Derrick's going to break that more into that. But here are the real differences, guys. Demand in this marketplace is different. And it's different because of population and family growth. Okay. We stopped building at a pace to keep up with population 15 years ago. Okay. It is a math problem. Now, because of inflation and because of the rising cost of building supplies, right? Builders are even slower to fix that problem. So no matter what, guys, we still have a mathematical issue with inventory. So there will be real demand. Now, for Maricopa County, guys, I talked to Tina Tambor. Demand is down by 5%, just so you guys know. So it's not, oh my God, 5%, but our supply is down by 63%. Okay, we're still not in a mathematical equation that favors buyers at the moment. The other thing is that people have more equity in their properties. Just so you guys know, between last year and this year, so I'm not even talking about like if somebody bought in 2018, just between 2021 and 2022, the average increase in equity was $64,000 according to CoreLogic. Okay, that's a large amount of equity. The other thing is that we've limited the number of investment properties, right, to 7%. We've been really constricted on that. We do see lots of, large corporations buying, but again, large corporations have shareholders and investors to answer to, so they're not just going to dump these properties, right? We saw that with Zillow. Okay. And the other thing is that we have like a war that we are like having issues with, that is impacting supply chain, that is impacting inflation. We have very, very low unemployment, guys. We have the lowest record of foreclosures that we've seen historically ever. I actually tried to Google when a time had lower foreclosures than now, and I couldn't find one. I'm not saying that there isn't one, but we are 0.2%, right? That's the number of homes that are delinquent. This is another fact, guys, that I thought was startling. 45% of homeowners own their homes free and clear right now with no mortgage. 45%. So if we're going to go and compare, right, because people are going to be like, well, this is just like history, this is just like history, we should compare it to a time when it's actually more accurate. So I actually did some research on this, and back in the late 1970s, early 1980s, right, we saw a very, very similar market where there was rapid increase in rates, high inflation. We had the start of the Iran-Iraq war, right? And we saw in this marketplace very similar conditions. And let me tell you that real estate still rose almost 6% in this time, right? It did not crash. It did not bottom out, right? Real estate was still the consistent investment in this economic time. And this is the time frame that I want you guys to be using when you're discussing this with clients. All right. So this, guys, is just an example of where we've seen real estate and what we've seen it do in the last 5 decades. So in the 1970s, guys, we saw almost 9% appreciation. 1980s, almost 13%. 1990s, guys, another 8%. 2000s, 6%. 2010s, 4%, right? And we're talking about after like literally the worst bottoming out of home values ever. So one thing that I want you guys to note about this chart that's important is that real estate typically doubles in value every 20 years. Okay. And that's regardless of what happens in the market. So if you bought a house in 2006, right, by 2026, that house should double in value. Okay. And you can really see that here. Not every year is a banner year, but like if $400,000 home that appreciates at 5%, which is what some of the more conservative estimates are for next year's appreciation, right, is still $20,000. Okay. If your down payment's 20,000 and your closing costs are about 7,000, right? You're looking at less than a 2-year 100% return on your minimum cash investment, which is unheard of. It doesn't happen
So
in any other kind of investment.
Lizzie, let's stop right there because I think this is such an important thing. And the term that everyone should write down is leveraged investment. You know, real estate's one of those few investments that you can make that with the power of leverage gives you that massive compounding effect that you just talked about. And so I'll give everyone very simple like numbers to write down. So let's say that you're working with a $400,000 house. If you have a client that's doing 10% down, so of 400,000, 10% would be 40 grand. So write that down. Be able to show a client 400,000, 10% down is $40,000. And then let's go very conservative. So I think that we can go all the way back to the 1960s and show an average annual rate of appreciation of over 5%. Let's cut it down to 3, because I do believe that we're going to see prices pull back. We are going to see a crash. However, the crash that we're going to see is not going to be in the home sales price per se. It's going to be in the rate of appreciation. It's going to be getting back to not 10, 15, or 20%. We're going to have a swing where it's 2 to 3%. And so if you just take that $400,000 house and let's just grow it at 3% per year. So over 3 years, that would be 9%. So, you know, Lizzie, help me out here. So what's 400,000 compounded at 9%? You could even do it simply and say times 9%. What's 9% of that?
$36,000.
Okay, so if I put down $40,000 and 3 years later I'm getting back 30, we'll see, that would be 4, 8, 12. So you're at 12,000, not even using the compounding rate of return, right? I'm making $12,000 of equity appreciation for something I put down $40,000. What percent gain on your money is that?
30%.
And so if you even broke it down, you annualized it over those 3 years, you're making 10% annual rate of return. The reality is when you look at what numbers have done over the last couple of years, most people are making 30 to 40 to 50% annualized rate of return because of a leverage investment. So going back to the point that you mentioned about not timing the market, the data is all out there. It's nearly impossible to time the market, but time in the market is what a financial advisor teaches. It's one of those things that we definitely need to show our clients because the news loves to sell fear. And so we're missing the opportunity to show people time in the market, and that if you're able to grow, 3 to 5% per year, and that $400,000 house, let's take 5%. So you go from 400,000, 5% growth is 20 grand, and then 40 grand, and then 60 grand. You know, you've already surpassed your initial investment in just 3 years. So here's a fun stat to share with anybody that's asking if real estate's a good investment. The average net worth of a homeowner is 50 times greater than a renter. 50 times greater because of, again, go back and circle that word, leveraged investment. So the math on here is show somebody what their down payment is, take the overall asset value, which is the 400,000 or the $600,000 house that they bought, and just move it up by 3% or 5% per year over 3 to 5 years and show them that cash on cash return. It will almost always be anywhere between 30 to 60%.
Thanks for driving that point home. I love that. I wrote down that stat myself. Okay. All right. So Derrick, one thing that I want before Derrick talks about this, guys, is I want you guys to remember back before the recession, you know, those of you guys who were born in the 70s, 80s, right? We had looming fears of the biggest financial event in our grandparents' lives, which was the Great Depression, right? Like this was just the thing that people talked about all the time. And it's because it had a major impact on our parents' lives, the same way that the Great Recession will have impacts for generations to come because it impacted our lives, right? Through our parents, and it impacted our children, right? So they were the casualties of bankruptcies, foreclosures, divorces, right? Everything that led up to people losing their housing. You know, my dad personally had his house foreclosed upon, and I remember it being a very traumatic event right? One of the big things that, parents provide to you, one of them is shelter and security. And so just know that people's fears, they're real, right? And this will be the fear moving forward until the next thing happens. But the Great Depression did not repeat itself, right? We learn from our mistakes, we just create different ones. Like, it's doubtful that the Great Recession is going to repeat itself, but something else will happen, right?
And
And
it's
so,
also one of the reasons why so many people are automatically going to a crash, right? We're going back to the 2008 recession and looking at that. That's a lesson for what happens in history of real estate, which is not really true. So I want to go back in time, because the reason that we're putting this deck in here about the Great Depression is you have to understand that the housing industry is one of the US economy's best weapons in terms of a strong, healthy, and stable economy. It's housing. And how do we know that? Because when the Great Depression hit, out of all the ideas and everything that the US government could throw at it, the best thing that they did, the best idea they came up with, was to grow homeownership. In fact, I'm curious, what do you guys think? Let's throw in the chat. What do you think the homeownership rate was prior to the creation of FHA? How many out of every 10 households, how many households actually owned a home? Just go ahead and throw a number in there, a number between 1 and 10.
I'm gonna say 1 in 10.
Yeah, so what's really interesting, and you guys, if anybody wants this data, you can literally Google when was FHA created. It'll take you to FHA's homepage where they share the stat. Before the creation of FHA, which was in 1934, 1 out of 10 households owned a home. And the reason why is financing it at that time was usually balloon terms with 50% down. So out of all of the things that we could have done as a country, we said we need to focus on homeownership. And so FHA obviously solved 2 problems. They created a longer term vehicle, again, that leveraged investment, and they allowed us to leverage a lot more against that with only doing a minimum amount down. It was so successful that homeownership after World War II grew above 70%. And now you guys know that the new number that we peg is between 6 to 6.5 out of 10 households. So that's now been decades of data based on the way financing is done of a healthy homeownership rate. Let's further expand on this. When you look at a shifting market, you look at the Great Recession that we had, FHA came right back in to be a great solution when all the subprime stuff went away. So again, you have a tried and true, well-qualified product here. And then in addition to the government's focus on creating FHA, you've always seen things like tax credits. When home values were upside down, when real estate did crash, the government introduced HARP, which allowed you to refinance homes that were upside down. You have the neighborhood stabilization program, where the federal government allocated millions of dollars to help communities that did have huge value impacts. When Lizy talked about some of the things that we're doing right now to change the market, second homes just got priced completely out. Why are they doing that? Again, they're trying to slow down things, so it really does create an environment for the first-time home buyer. And there's still so many things that the government has already done that we could deploy to help with affordability. If things continue to get to a point where it's just so expensive and your average American can't get into a house, they could easily reintroduce the 40-year mortgage. But they're not doing that right now. We're going to show you because demand is still so high. The sales are still so high. So the point of all this to say is rest assured that, yes, there's a lot of fear. The market will be much harder than it's been the last few years. But again, you have the federal government completely in your corner to make sure that housing stays strong and stable. We are going to have some corrections, but all the data we're going to show certainly makes me feel like we're not going to have a crash. These slides here just further point to how impactful the real estate sector is for the US economy, making up nearly 17% of the overall GDP. And you think about it, and you own a house, all of a sudden you're picking out curtains and furniture, and there's just so much economic activity that spins off it. You're adding stereo systems and solar, it is the nucleus of a strong economy. The next slide actually shows the impact for Arizona itself, which Arizona is extremely vested in real estate at nearly 20% of our GDP coming from everything related to real estate.
So one of the things that I believe personally is that this is the type of market for experts. And so we are just too full of inexperienced loan officers and inexperienced real estate agents. And this next 8 months is really going to show who you want to work with. It's like, not easy to sell a house, right? We know in a traditional market, and we know it's not easy, right, to put a buyer in the right contract. And so it's not easy to write the right home loan. So a couple of things that I find to be super helpful is understanding where your expertise comes from, right? And so a good example of this is providing information for things that are changing, right? So for instance, one of the biggest changes in lending has to do with how the credit changes, right? So it has to do with how collections are going to be reported to the credit bureaus come July. And being able to talk to people about how this will impact their home search, their interest rates, their loan amounts, right? And if you have an opinion on whether or not this is good or bad, right? That's what makes you an expert. It's not just the information, but giving the valuable information that will help someone be successful and giving them your success tips is going to be one of the key things that will separate, the beginners from the experts.
The big cry over interest rates and, oh my gosh, they're moving up so much. It's relative to what? I mean, if I showed you this chart and I said, this is your 401k return, you would be pretty sad because overall the direction of this chart is going down. And so when the news, which loves to sell fear points, talks about these huge increases in interest rates, again, relative to what? We've had a global pandemic where everything was shut down. And again, the Fed being invested in real estate knew that one of the things they had to do was continue to buy mortgage-backed securities. So they did it with a blank check, basically. And that's what drove down the treasury and drove down mortgage rates. And they have this huge balance sheet of money that they've printed that they now need to unload. But if you look back at that prior deck that we showed you, in 5 decades, that the average 30-year fixed rate is over 8%. So that means that in 50 years, if you're getting a rate sub 8%, you're timing the market very well. But it's so easy for people to go, my sister bought when rates were 2.5, or my dad got a 3.25, like this is awful. Well, remember that if real estate traditionally appreciates at 5%, and we have decades and decades of data for that, get the house, own the home, and when the market does bring back a low rate cycle, if that does come, then you can always refinance. But even if you could not, a rate at 5.5 or 6% is historically an all-time low, only surpassed by a recession worldwide and a pandemic worldwide. Those are the 2 instances where you have rates that were significantly better than we're at right now.
And so a couple things that I want to mention about that, guys, is that most people have to live somewhere and most people don't get to live for free. Okay. And so when we're talking about rising costs and interest rates, you have to then offset it with what else would you be doing with those funds, right? Because chances are you're still going to be paying for housing. Now, the difference in that housing, right, might be the difference between an investment and not. And some people, it just doesn't make sense for them to be homeowners. That's a truthful statement. They should pay down debt. They should save more assets, right? But for most people, right, when you talk to them about investing and the fact that they need a place to live, right, they can get over this hump. Now, I do want to explain to you that, with every 1% increase in interest rates, people lose about 10% of purchasing power if they want to keep their same payment. So some people have lost about 25% purchasing power. And this is where your expertise again comes into play, right? We as loan officers know, right, that there's different strategies with mortgage insurance, that there's different strategies with like income, like do you qualify for a home ready loan or larger down payments? Or, there's other things that we can do to help a client, right? But not just your Quicken Loan people, the people that you just call in, will they know that information? So sometimes that purchasing power that was lost with an interest rate can be made up with the way the loan is structured.
Great example of that, Lizzie, is as you're talking to more agents right now, I feel the shift, right? It's used to be get your offer in and there's 10 others and we're going to go 50K above and waive the appraisal. And now more that I'm speaking to are saying, oh, we actually had to do a price reduction. And so a great example with that is, rather than doing a $10,000 price reduction, maybe talk to your lender about a $7,500 credit to do a 2-1 buy down. And then your buyer can get that 3.5 rate from 2 years ago. So those are things that we're already in discussions with and showing listing agents how they can still save their sellers money because, instead of doing a $10,000 price cut, they went 7,500. So they kept 2,500 in their pocket, and buyers are able to get those lower payments. So if rates do drop in a year or two that some are forecasting, great, they can just refinance at that time and still have a payment today that was equivalent to what they would have got 2 years ago. So looking at this deck, we talked about there's other tools like the 40-year amortization, right? There's easy buttons and levers that the government can introduce to help if this problem really becomes bigger. The fact of the matter is we're not there yet. And the reason why things like second homes have been priced out is because this is still one of the strongest purchase markets ever. And you wouldn't know that by talking to real estate professionals or turning on the news because so much fear is being pumped out there. But again, you look at historically how many homes are sold in the US. You look at what we had in the last couple of years, the rates being all-time low, even with these forecasts being adjusted downwards by 5 or 10%, it would still be some of the busiest markets that we've had ever on record.
So one other thing that I want to mention about this too is that there's a difference between affordability and affordable housing, and the news and media, and actually most real estate professionals get it wrong. So just so you guys know, with inflation, incomes have also increased. And so this chart and most of the charts are showing that people are still able to afford homes, the majority of people, right? Which is how, when increased inventory comes on the market, it's easily met with the demand that exists. There is a shortage of affordable houses for people that are under the median income. Like that's the actual problem that they're discussing on the news. But because people don't relate it to like, oh, it's just affordable housing, so houses that are under 300,000, they then hear, oh, no one can afford a house. So you
on
guys,
that note, Lizy, there was an economist that I recently saw speak, and he said, you got to be careful with data, especially when we look at the whole macro picture. Now, you take out the Starbucks barista, and you take out the high school, summer job employee, and you look at, true professional employment. And believe it or not, the increase in wages last year was 9%. And so it actually eclipsed the increase in housing by about $100. So even though payments are up over $800 on that, median sales price, income for those professionals was up $900. So again, it's what we focus on, and hopefully you can dive in. If you're a realtor lender, you can talk about what's been their experience with their income the last few years. You can even see it if you're on the lending side. A lot of people have strong, steadily increasing income, and you could break that math down right to if they would have bought a year or two ago and see if they truly are in a deficit. In many cases, your people are going to be even or even exceeding what their payment increase has become.
Yeah, and there's some charts that you guys can Google, but the affordability in the 2000s, guys, was in the 30%, right? Affordability for like your house payment to your income right now is still under 29%, right? In this marketplace with higher interest. So it is stuff to definitely look up, right? Because people they're in a better financial position today with rising interest rates and increased home values than they ever have been. Okay.
This just makes my point. So this goes back, and you can look at all the way back to the early 2000s, and you can see how many households or how many homes are sold per year. And so again, with it being projected 6+ million, we're looking at, again, all-time highs. So Liz and I were talking, and this is the big word, right? Recession. The reality is we are in a recession. It has not been announced just yet, but like Lizy said, the definition is 2 declining quarters, and you can see the writing on the wall. You can see the increased debt rate, the decreased savings rate. And so let's just call it what it is. We are in a recession, or there's a very, very high probability that we're going to go into a recession, which for real estate does not necessitate that that's a housing crisis. In fact, this is a great chart, steal it, because it's rare that ever real estate goes down during a recession. In fact, the only time that that happened was the recession that was caused due to poor real estate policy that Lizy started this presentation with.
Yes, guys. And just so you guys know, historically, when there's a recession, again, the Fed comes in with monetary policy, typically to adjust mortgage rates down. So obviously we're not clairvoyant. We have no idea if interest rates are going to go down or not. But historically, interest rates go down with recessions because the Fed buys mortgage-backed securities to stimulate people doing refinances, home improvements, purchasing new properties. So it is likely, right, that in 18 months, interest rates will go down. We did see this, guys. If you look back not that far, like 2018, right, we saw interest rates rise into the 5%, right? And then again, when there was economic challenges or scare, when there were fears, right, they lowered those interest rates down. And so I expect that this will happen somewhere between, second quarter, third quarter, up until like first quarter of the following 2024. But I believe that interest rates will go down.
And Lizy, there's a great chart on that shows the history of interest rates, and there's a recession overlay on that touches on your point that nearly every recession is followed by a drop in interest rates.
So we wanted to do like a real estate report card for where we're at, like in all of the things. So I'm going to have Derrick go through them.
Yeah, so this is Phoenix. So I know we have people from all over. This is a great tool if anybody wants to access this information. There's a service, MBS Highway, that lenders subscribe to that gives you a report card by county or by zip code. And so I think that there's a lot on this chart, but there's a few things that I'll highlight. One is if you look at the center top portion where it looks at the forecast for appreciation, even with Phoenix being a hot market, even with the median sales price in Phoenix being above that of the national average, you're still looking at a 5-year forecast north of 20%. Builders are still so gun shy from what happened in 2008 that we're going to continue to be in this supply issue where it's going to hold pricing. So again, I think we're going to have a crash on appreciation. I think we're going to go away from 20% down to 3 to 5%. But we just simply have too much demand, population growth, and we do not have the product to satisfy that.
So this is where we maybe disagree a little bit. I don't know that we would have like appreciation go all the way down to 3%. Just quite frankly, because we still have a really great demand and we're still in a position where we're so undersupplied with housing. Okay. So whenever those are the conditions, we will still see a pretty aggressive seller's market. Sellers markets traditionally, guys, are 97% of list price. And right now we are over 100%, right? Yes, there's some homes that are having to be adjusted price-wise, but when you're looking at like the value of somebody's home versus what it sells at, they're typically different prices. And that leads me into you guys knowing the difference between what market price is versus the value of homes. When people talk about a housing crash, they typically think of the value of my home. So if my home, like if homes in my area are selling for 400,000, my home is worth 400,000. There are no homes available for sale. So even though my home is worth 400,000, I might be able to sell it for 450,000. That is market price. So market price is what someone will pay to buy your home today. Okay. So what somebody is willing to pay today, right, is market price. So yes, market price is being adjusted. Okay. It is less competitive. That is what we're really talking about. Home values, right? Like what a home is worth is different. And in knowing that as a salesperson is very important, right? Because when they talk about crashes, people think home values, right? They don't think appreciation. They don't think future price. They don't think what I'm being offered on my property, right? They think of what my house is worth. Okay. So you just have to really hone that in, because I personally think that we're still going to see double digits the rest of this year. And I still think we're going to see single high digits next year, especially in this state. You know, national averages are always lower because you account for every single type of marketplace. I know there was a question earlier about, these are all national stats. Arizona doesn't provide lenders with all of this really great information just about this specific area, but I'm sure Tina Tambor can get you something. But all of the statistics we typically have are national statistics, like on foreclosures, forbearances, all that stuff. But this is a really, really good one, right, to utilize to again show like why values wouldn't go down.
Mhm.
Right. And I think that's just an important point to drive home.
So let's look at next one is Tucson. So again, apologize for everyone who's joining us everywhere else, but you can get this on any market. So very similar story. We have over 100,000 people that are renters that could be homeowners. We are building, we're not even keeping up with half of what we need to be building to make up first-time homebuyer supply. $80,000 equity growth over the next 5 years, over 20% appreciation. So this is important to share. I had a client yesterday that was in an offer situation where the appraisal came in low and the deal was falling apart. And I was asked to give a second opinion as another lender to look at it to see if we could save the deal. And one of the strategies that we were offering was appraisal gap using single premium mortgage insurance. And the wife said, well, I just don't want to spend more than $5,000 on the gap. And I said, okay, well, why do you feel that way? Well, just because that's as much risk as I'm willing to absorb. And again, when you look at the data, right, that, we were talking about a $30,000 gap to make up. And we look at what prices have done just in the last 3 years at 20% per year, even if it is only 3 to 5% going forward, she would make her money up in 2.5 years conservatively if she went aggressive and made up the whole appraisal gap. So I think knowing those numbers and how we're going to be those experts that you touched on, Lizy, is we have to be able to know the data and share that because whether you're in a hot market or cool market, there's always somebody who's trying to time it. There was people that when rates were 2.5%, were still waiting to think that rates might go lower than 2.5%. And so you got to be able to give people facts. And I think that anyone who's in that situation where they're like, I had to win this house, I had to pay $10,000 over. This is great data to share with them. And you can show not only the forecast looking at the next 5 years, but you can literally show them the last 5 years and the same conditions that you touched on, Lizy, with the supply just not being there. Where does the drop come from? What data supports that other than a news headline, which is consistently wrong?
Yeah, and again, guys, the news just goes off of the information that's available. A couple of months ago, they were talking about a record number of foreclosures, and it's like, yeah, a record number compared to the last 2 years where they didn't allow anyone to be foreclosed. So literally 10 is like 10% increase is like double-digit increase, sounds really catastrophic, and it's really nothing, right? When you look at the big scope.
There's 89 million households in the US. You already touched on the fact that 40% are free and clear. And it's estimated that in the next 2 months, with the way that appreciation is just ticking along, that about 1% of homes in America will have negative equity. That's it. And so as time goes on, it'll just even be a smaller number.
Totally. Okay. So in summary, guys, it's a very fearful market, which gives us a ton of opportunity to show up as experts. Okay. Market shifts, guys, also create a ton of opportunity, right, to have way more conversations, right? Like I have way more reasons to call my clients, way more reasons to call my referral partners, way more information to make a video about, right? We just in general, real estate is very strong in terms of demand, supply, right? People's ability to purchase, people's need to purchase. We're in a good position.